Welcome to another episode of the Capital Playbook. We are happy to have you here. We are at the MBA conference here in San Diego, California, and we have an opportunity to talk to some real experts that gives us real insight into what's happening in commercial real estate, especially as it relates to commercial real estate finance. But before we get started today, we're going to ask you to do something for us, and it's what we always ask you to do, and that is to like, subscribe, and share. We want this podcast to be the biggest podcast as it relates to commercial real estate, and we can only do that with your support. That allows us to bring in true experts to talk to us about what's happening in commercial real estate, and that brings value to you. And today you're going to really find our conversation valuable because we're talking about financing from credit unions. And we have a real expert here with us today, Mr. Dexter Mesa. So he is the VP of Strategic Initiatives with CU Business Groups. It's an organization that brings credit unions together for the purpose of giving you a loan. So you absolutely want to be a part of this conversation and hear what Mr. Mesa has to say. Thank you so much for being on our show.
Thank you so much for having me. Again, my name is Dexter Mesa, VP Strategic Initiatives for CU Business Group. We are a credit union service organization, and what we are owned by the 6 largest corporate credit unions in the U.S. And our main purpose is really to serve credit unions. Mm-hmm. And at this point, we serve nearly 650 credit unions nationwide, mm-hmm. and we provide everything commercial lending from underwriting, consulting, audit. In my particular space, I oversee our debt fund, which mm-hmm. I will be talking about later on during the conversation, as well as our loan sourcing and participation area.
I really appreciate you saying your name correctly. Been a long day here. We filmed multiple podcasts, but so you're in this space, which is a very unique space to be in. It is. But how did you personally get started in banking, business lending? What got you to the spot that you're at today?
Sure. No, thanks for that question. So I've been in the lending industry at large for the last, it's close to 29 years now. Right. I started off in the residential lending where I was a broker direct lender. Okay. Up until 2008, magic number.
Something happened.
What happened there? Yeah, exactly. So from there, I was really looking to transition into something related and something exciting. Right. And on top of that, with all the different things that happened during that time, I really wanted to be involved in something that was extremely benevolent. Something that's, meant to be of service to people. And credit unions really filled that gap for me. Mm-hmm. And, at that point, 2008, I transitioned to commercial lending, mm-hmm. specifically down in Southern California for a company called, formerly known as LA Firemen's Credit Union, now known as Firefighters Credit Union. Okay. I spent some time there developing their program, mm-hmm. implementing some of the processes that was in residential lending, but very much transitional, and you can transition over to commercial lending and develop that internally. I stayed there for about 4 years, after which I was recruited by another organization, another credit union organization, to go ahead and start their commercial lending program from ground up. I mean, truly from ground up here. Mm-hmm. That involved writing policy, getting board approval, getting regulatory approval, both state and federal, and launched that program and, grew that program to a healthy size. I just continued on that path. I was actually there for, again, 4 years, mm-hmm. After which I was recruited to another credit union where I essentially headed up both their commercial and their residential piece. Mm-hmm. And of course, just applying the same experience, same background that I have, and brought that value proposition over to that credit union and just really enjoyed it. I was recruited after that
by this whole recruitment thing is a recurring theme.
It is a recurring theme, but it's really, it's a real, I'd like to think that I provide a lot of value to each organization that I serve, quite honestly. And, proof is in the pudding, right? Right. But, and so, I worked very briefly for a bank in Beverly Hills, and, within just a little under a year, I found that my true soul, my where I belonged, truly is in the credit union space. And it's at that point that I reached out to my boss, the CEO Larry Middleman, and shared with him my yearning to get back in the industry. And I found that CUBG, it has the highest reputation in the industry from a QSO standpoint, commercial lending QSO standpoint. And what a better way to go ahead and touch credit union the credit union industry than signing up with a QSO that has, at the time, I think we had just a little over 500 credit unions signed up.
Wow.
So that was very exciting for me, and that was also at a time when, CUBG was getting ready to launch the fund, and they really needed somebody to go ahead and help with that process. And I was very excited and happy to go ahead and fill that position.
Okay, well, good.
Yeah.
Well, give us some basic information. The question I've always had is what really is the difference between a bank and a credit union?
Sure.
Okay,
So,
because they look a lot alike to me.
very much. Yeah,
but I know there's some
very different.
Okay, well, help us understand
so the first main difference is that credit unions are nonprofit, which means that being nonprofit, they can drive the savings directly to its members. Notice how I mentioned members and not customers.
Yeah.
Right. So essentially, credit unions are a co-op, and it's meant to really provide value to each other as a member, right? And so that I would say is one of the biggest, or if not the biggest, difference between the two. The savings that the credit unions are able to deliver to its members are a direct result of it being a nonprofit organization. So it's member centric, and it's driven by its members.
So in terms of cost of capital, like banks, they're able to get those federal funds, and then they get their funds from obviously savings and so forth.
Yeah, absolutely. I mean, credit unions do rely on that as well, but most really the capital is really coming from its members. The shares.
Good.
Yeah.
So they have pretty low cost of capital as a bank.
Absolutely,
Yeah.
and that's driven right back to them in the form of savings on the rates on loans and such.
Okay, well, very good. So now, CU Business Group technically isn't a credit union.
It is not.
You call it a QSO.
Correct.
Okay, so what exactly is a QSO? What is that business model?
Sure.
And how does that business model benefit a borrower?
Sure. So a QSO, again, just to define what the acronym means, it's a credit union service organization.
Okay.
And what that is call it a collective of sort. Okay. It's an organization meant with a very specific purpose. In this case, it's commercial lending services, all things commercial lending.
Okay.
And it's usually funded, and I say usually, always funded by a credit union or a collective of credit unions to go ahead and fill the gap of resources that they need in order to facilitate one thing or the other. In some cases, there are QSOs that are primarily residential. Residential QSOs, and where their main function is to go ahead and originate and service residential loans.
Right.
There are investment QSOs, whereby it's a wealth management QSO that allows for credit unions to go ahead and provide that service to their members, in a very cost-effective manner.
Right.
All right. And in our case, we're on the commercial side, so we're a QSO owned by the 6 largest corporate credit unions, and our main goal is to service, again, credit unions' commercial lending needs, whether that be from a consulting standpoint. We've actually helped form programs for credit unions. We provide consultation. We provide, audits. We provide, again, in my case, I oversee the loan sourcing and participation area. And our main goal is to go ahead and drive business to the credit union or credit union members, and do that in an efficient way.
Okay, well, very good. So you're originating these loans, and of course those loans are, for lack of a better word, they're syndicated or participated out to certain member credit unions that are associated with your organization.
That's one way.
Okay. Yeah.
So we cover quite a few things. Okay. So we essentially source loans, place them with the appropriate credit union, right? That where the borrower fits the field of membership.
Okay, so you may have a deal that fits a specific credit union.
That's correct.
As opposed to, and so therefore it does not need to be participated out or syndicated out. Okay,
correct. We'll have just direct placement.
Mm-hmm.
I think one key, well, before I move on to that, but we'll also, syndicate out deals as well.
Okay.
Where you have let's say larger opportunities in the area of 50 million.
Right.
That's a concentration risk for credit unions.
Right.
In many ways it could concentration both from an aggregate, borrower caps that credit unions have to abide by from a regulatory standpoint. And also on top of that, it could be a concentration just from the asset type. That's a large deal.
Right.
That's a heavy load. Depending on the size of the credit union, it could be a heavy load right on their portfolio. Mm-hmm. So what we'll do to mitigate those types of concentrations is, again, to go ahead and syndicate that. Mm-hmm. And last year, we had actually launched a digital loan marketplace platform. We launched it actually at the same time as we launched the fund.
Okay.
And that was purposely that we did. That was on purpose that we did that. And that allows for us to more effectively and more efficiently get the opportunities in front of our membership, our 650 credit union membership. Yeah. And it's been pretty effective.
Well, that explains a lot because, when we were talking earlier, I've had some experience with QSOs in the past. And one of the things that I've experienced is it just took a long time to get a deal approved, to get it closed. And when you're involved in commercial real estate transactions, you're usually on a pretty tight time.
Oh, absolutely.
So the way you've solved that problem is creating this. You've used technology to help your process become more efficient.
Absolutely. That's one of the solutions that we put in place. The other solution is control. And what I mean by that is, many credit unions, they're also very busy with their own organic originations, right?
Correct.
And there are also other credit unions that have minimal resources, but want to engage in more organic originations, but just don't have the
capacity,
staffing, the staffing resources, the capacity to do so. So we, about a year and a half ago, I formulated what's known as the Contract Commercial Lending Program.
Okay.
And that was really launched in a very careful way to make sure that we are truly delivering on what we promise.
Right.
Okay. And that's a very cost-effective and efficient way to get deals, or loans processed, again, in a very efficient way. Our timetables are, 45 days, 60 days, even with the appraisal delays that everybody is experiencing right now. So, I've revamped the whole team, quite honestly, okay? And, we have years of experience. Each team member is a veteran. I've got my right-hand person on the admin side who's got 25 plus years of administrative and processing experience. I've brought on some commercial loan officers with also 15 plus years of experience. I've got just hired a new guy that is in the private equity space that is also seasoned in that area. That brings a lot of value on the front end. I've added 2 other team members to support, of course, my admin person. We are just, quite honestly, simply a finely tuned machine at this point.
Great.
And so very excited about that. And we are delivering, and part of our strategy this year, as part of that contract commercial lending campaign, is we signed up essentially 2 handfuls of credit unions that know us, right, that understand how we work, understand the program, that are very much have tremendous capital to deploy, right, and are ready to take on commercial lending, but not necessarily have those resources as we discussed.
Right.
So we essentially have an agreement. Technology is one piece, right? The second piece is really hammering down the appetite,
right,
and the flow of communication between the credit union lender and CUBG, right? And a lot of that has to do with trust, that is earned.
Right.
Right.
Yeah, you have that track record.
We have a track record of delivering. We have a track record of integrity,
right,
and highest reputation in the industry. And that's what works for us, and that's what we want to continue to uphold, is that track record of integrity and execution, right? And so we signed up 2 handfuls of credit union, whereby part of that strategy and partnership is to essentially engage and facilitate different funnel marketing campaigns that offer specific value proposition, a very unique but temporary value proposition, right? We can pull different levers, right, on different campaigns. One being, what's the number one value proposition? Price. Right. Right. That's where everybody goes to. But, on top of price, you can also engage in, different levers that you can pull. You can maybe a specific niche, right, that you'd like to target. Maybe in your portfolio, you might be top heavy in multifamily. You want to go ahead and boost up your light industrial. We can formulate a campaign that can drive that type of business, maybe self-storage. Let's drive that business into your direction, right? Okay. But it has to be a very, a unique value proposition that is meant to front load that, all that, business development within that 30 to 45 day cycle of the campaign. So we've had quite a few campaigns already. We've ran, from the time I launched it, we've had 4 campaigns already. And they were, quite frankly, we hit the mark on every single one of them. So very proud to share that. And that's also a lot to do with partners like yourself, where we partnered up with different brokers, and different investment groups that understand what we're about and understand our certainty of execution. And so it's been a nice flow, quite honestly.
Okay, good. So now you're with your structure, your organization, you guys are able to fund pretty much every asset class, because you mentioned you're doing hospitality, light industrial, self-storage, multifamily.
Yes, absolutely. Credit union appetite, the credit union staple is multifamily. However, with the increased or continuing loan to share ratio compression, we found that, number one, credit unions are becoming more informed and educated about commercial lending. So you'll find that more and more credit unions are engaged in commercial lending, commercial real estate lending to be specific. And so that appetite has expanded just in the last, I would say, 5 years. Okay, so the normal credit union staple used to be multifamily, but now we've seen tremendous appetite in light industrial, self-storage, office, certain retail, drive-throughs. You mentioned hospitality, but that's very specific to mid-tier hotels.
Right.
These types of that asset class was, we'll call it, impacted, but on a very minimal basis.
Right. Yeah.
During the pandemic, as you know.
Yeah, the limited service and the mid-tier full-service hotels actually did outperformed.
Yeah. Exactly.
So, the folks that had those in their portfolios, they were a little bit worried. Right. But lo and behold, it actually performed very well. Right.
People, I take my family to go, do a drive trip, a driving trip somewhere, So. Yeah. So those fared pretty well, and as a matter of fact, we just closed a couple not too long last month, a couple of Motel 6s. Right. And we're very excited about all those asset classes that I mentioned.
Yeah. Now, what stages of the life cycle would you do? Construction, acquisition, rehab, or are you just looking at stabilized assets?
Yeah, so we're looking at 2 things, right? So the majority, I would say 98% has to be stabilized. Okay. Right. We will facilitate construction deals. The more and more credit unions are engaging in that space. They're bringing in the talent, the talent that understand and has experience in that space. So we're seeing more of that. There's one particular credit union that we've partnered with that really enjoys tract home development. So that's something that we're very receptive to, and we've done a few of those actually just last year, as a matter of fact.
And how high on the capital stack would you go? You're at 75% leverage in general, or would you go up higher?
Are you talking specifically?
Let's say if it's and that's a very good question, because obviously it's one of those questions where the answer is always it depends. Right?
Exactly.
Right. So let's say multifamily transitioning asset acquisition rehab. Okay. What would your loan to cost versus your loan to stabilized value what would that look like?
Sure.
Is that something you would entertain?
Again, we like to focus on stabilized.
Okay.
So that's, for that, we can go as high as 75% from a regulatory standpoint. I think it's changed lately. I believe it goes to 80, but nobody goes 80. It just doesn't support it.
Right.
The cash flow is not supported by that high of a lever. What we're seeing as a common lever for, let's just call it the stabilized multifamily, is 70%, 75%. And again, the last thing you want to do is submit it at the bare minimum $1.20.
Right.
That's just,
Right.
even though it's there,
you like to see $1.25.
Exactly.
Yeah.
Exactly.
Okay.
So, you want to buffer that just a little bit, and so that's the lever that we typically see on something like that.
So now, as you've had an opportunity, because your client, which is the credit union, and then of course you have your borrower. When you're making that match between the right credit union product with the right borrower, what does that borrower have to do, or what would you like for them to do so that they are most prepared to do business with a credit union?
That's an excellent question, and you come across everything, right? Because
absolutely.
So as I'll share what I consider a funny example.
Okay.
That just happened about 2 weeks ago. I came across an opportunity where we got on the phone. It's essentially a blanket loan. Blanket loan is defined different ways by different people. It's essentially a portfolio loan, whereby it's a collective of, I want to say it was a $19 million loan with quite a few SFR rentals on them, on an LLC. Pretty basic stuff, right? And the borrower during the conversation was sort of speaking in a position of, well, what can you do for me, right, type of situation. Well, I don't want to be identified on this or that. He was essentially dictating,
Yeah, he wants to use your money and tell you how to lend your money to him.
Thank you. Exactly.
I've had a couple borrowers like that.
Yeah, and so, one thing that I politely always share is that I'm number one, I'm your advocate, okay? I'm here to help you.
Right.
You know what I mean? My team is here to help you get this done.
Right.
But I think from a borrowing standpoint, you have to also understand that you're borrowing money.
Right.
Right. And this is not essentially, when you're borrowing from a credit union, you're getting the best deals.
Right.
Period.
Yeah.
You're going
to get a great interest rate.
You're going to get
product.
a great interest rate. Most credit union deals, and I forgot to mention this, are transactional. So they're not going to ask you, hey, you need to transfer your operating account over.
Right.
They might want a little bit of a relationship, maybe, right? They want to grow your lending relationship, and of course, just have a respectable deposit relationship, and that's vaguely defined.
Right.
But you are going to get a great deal.
Right.
And so the way to tee that up for themselves is to, number one, have a good executives, essentially not a super fancy or long, a 5-page, 10-page executive summary, just enough
so that we understand the deal.
We understand the deal. We understand you.
The property, understand the sponsor,
Absolutely.
Understand the loan opportunity,
Absolutely.
and how are you going to pay us back?
Absolutely. and even on top of that, exactly.
Right.
And on top of that, maybe a little bit of your infrastructure to give us some peace of mind that, you have all these assets, right? That you have the appropriate infrastructure to manage them appropriately, right? Because we all know, management can make or break, your cash flow,
Absolutely.
right? And so, something like that, that's a starter. You have an executive, have your financials ready, complete your PF. These are all the basics.
Yeah.
Right? Have a
Make sure it's
PFS.
accurate.
Make sure it's complete and it's accurate.
Right.
The more you want to make the lender, or in this case, we're the proxy lender, right? The longer it's going to take. So many of our brokers and borrowers that we deal with on a regular basis, they know the routine.
They come prepared.
Right. And I kid you not, we get you an LOI the next day in many cases. I mean, really.
Yeah.
And these are not, these are LOIs that come from the top.
Right. And they're solid. And, we talk about so often on the show for folks who are borrowing, everybody wants to do it themselves. And they think, they're going to get the best value, best rate, best terms in their mind. having a qualified intermediary,
Yes,
who has the relationship and who knows how to pre-underwrite and approve your deal. You have no idea how much time and how much money and how much headache that is going to save you.
You hit it on the head. I think partnering with the correct intermediary tease that up appropriately, because they can coach you appropriately as far as, hey, you need to tweak this a little bit,
right,
or that, adjust this just a bit. You need to complete this.
Right.
We need to tee it up so that you have an LOI in the next 2 days or 3 days at most.
And then you go into closing.
Exactly.
Yeah.
Well, not quite. I mean,
it starts the process of moving into
absolutely.
closing.
I mean, that gets it going.
We got to get third parties and make sure everything you said was true.
Absolutely. So teeing it up is a big deal, and it benefits you as a borrower, quite honestly. And so that's how we stick to our 45 to 60-day closing times. I know a lot of people tout that around, but we really do close within that time frame.
Right.
And one thing I think that you're going to find with our team is that we have high levels of communication.
Mm-hmm.
High levels of communication. What we found during the pandemic, when we had to go remote, is that Microsoft Teams has really served us really well.
And we use that, and
it's amazing.
And I'm gonna do a shout out for HubSpot. I know a lot of people are still on Salesforce, but if you haven't tried HubSpot, it's the bomb.
Absolutely. I mean, it's made us tremendously more agile.
Right.
With the Teams calls and so forth. And that's how I would describe our team, is just high level of execution, high level of communication, high level of agility to get things done.
Yeah.
And so I think that's what you, a person like yourself or another intermediary, can count on, even as a borrower. So just a high level of execution.
All right. Well, excellent. Well, I tell you what, we have certainly enjoyed having you, Dexter, onto our program. CU Business Group. Man, I don't know why. I think it's been a long day, but it's not sticking. But CU Business Group, his information is on the screen. Thank you so much for being a part of our show, being here with us in San Diego. And I guarantee your phone is going to ring. We get usually 5,000 to 6,000 viewers, and I'm sure some of those are looking for loans. And this is the man to call. If you want us to help you and be that intermediary, that's great. But you're certainly welcome to call Mr. Dexter directly. They have a great organization. And just think about the power of all those credit unions coming together to make capital available for you. You are part of the discussion. You're a part of this playbook. You're in a position to win. So keep supporting this podcast by subscribing and liking and sharing. And until next time, we hope you have a great week, and we'll see you next week at the same time.